Hope everyone is doing well and had a good day. I'm going to make some adjustments on the chart and then I will start the review. There we go. The stream is on a different computer and the workspace did not save. So I'm just going to redraw the main pieces. We'll draw it as we go, make it easier. So overall on the day, probably the most important piece of today was the opening range. And I'll talk more about that in a minute. So on the daily chart, the bulls are getting climactic, and we can see this is the ES. Let me just go to the day only. But you can see buy climax, pause, buy climax, pause, big bull bar late in the move, and then a small doji. I thought that increased the probability of the market pulling back. Let me check the sound real quick. Someone was saying there's a sound issue. And looks like the sound's working just fine. So back to the review. Strong enough sell-off, probably at least a small second leg. So in other words, if we rally on the open, there's probably sellers above and we'll probably get a second leg. So I think sideways over the next day or two. Weekly chart is important. We have one trading day left in the week, and the close is right now the market's at 65.75 and the low is 36. So we've only got about 30 points to get to the low of this week. So that will be a magnet going in tomorrow. It'll be interesting to see, will we gap down? Can we get to the low of the week? And can we perhaps make this a bear bar? So when you're looking at this chart, you see yesterday, and what are bulls doing? Bulls are buying, bulls are selling out of longs into the close, and bears are selling to go short. So going into bar one, my one thought is the open of the day is going to be important, and we're probably going to try and close below yesterday's low, which is right here. It's yesterday's bar 59 low. So I know that's a magnet. And then we see bar one. Bar one, good looking bull bar, but it's a really big bull bar. And when you look at that, you think to yourself, yeah, it's a strong enough bar, probably at least a second leg. You can make the argument it's a wedge bottom with 18, 50, 59, and then 1. But big bull bar, tight channel, parabolic wedge with 74, 79, and bar 1. So all good things for the bulls. But the channel down is tight from yesterday's bar 72. And big bull bar on 1, that will increase the probability of sellers above. You can see we sold off into the close. That's a warning that something is not quite right. It's similar to this bar right here. Bar 2, we went above 1, sold off. Still, are we always in long? I think so. Probably buyers below 2, scaling in lower, but micro double top on 1 and 2. 3, we have a high 1 buy, probably sellers above 3 for at least a scalp, but I suspect there's buyers on any pullback. Bar 1 and 2 are strong enough for a second leg. So there's probably buyers somewhere in here. 4, a bull bar, failed to close. We closed above 3, good for the bulls. But we failed to close above the 2 high. And for that reason, that's a warning that something is not quite right. But you can see bears sold above 3, and there he got out around the midpoint. 5, an inside bar. It's a warning that the market is probably forming a trading range. We're testing up to the 81 low in this area and starting to go sideways. 6, we broke below 5, but could not close below 5. And then 7, bulls giving up. Strong bear bar on 7, enough to make the market probably always in short and going to go lower. Probably going to fall below 1, but the size of bars 1 through 4 make the probability that the market's going to be in a trading range. So even if we sell off, we'll probably get back to this area and at least test it. Bar 8, bears sold a close of 7, but they scalped out below 1. Are there buyers or sellers below 1? There's probably buyers, but fairly tight channel, micro channel since 4. First reversal up probably will fail. Any bull that bought a pullback of bar 1, the breakout from the 1 low to the 5 high or the 4 high, they're trapped and they will probably use any bounce to exit. 9, you can see the tail. It tested the close of 7 and sold off. So some bulls, they bought the close or on the way down. They bought and they got trapped with follow through. The bears got follow through, so the bulls were wrong. So a bull that bought this close disappointed on 9. Look what they did on, disappointed on 8. Look what they did at the 9 high. They got out back at the 7 close. 9, now we have 3 bear bars, 2 follow through bars after the bar 7 breakout. Strong enough, we're probably going to go lower. Overlapping bars. What are the odds that we go straight down? We'll probably bounce, but the channel down's tight, so there's probably sellers above. 10, bear bar, closing below 9, closing below 1. Always in short, probably going to go at least a little bit lower, but we're at the 60-minute moving average, so there's probably going to be support somewhere around this line. Whenever you get to the 60-minute moving average, the market can often go 5, 6, 7, even 10 points below before it pulls back. It's similar to yesterday, the 4,600 big round number, which is basically this red line. The market went far above it, even got a second leg, but could not escape it. And I think that is probably the reality here. We'll probably we'll go below the 60-minute. We already are starting to go below it, but we'll probably have to pull back. And you can see here, we sold off. We went below the 60-minute moving average, this line, a little bit below it, but we snapped back and even went above it. 11, now we have 7 consecutive bear bars, 8 bar bear micro channel, probably sellers above, but becoming climactic. It's sell the close, but you really want to sell the close after this many bear bars. I suspect more traders interested in selling a pullback. Doji on 12, that's a warning. Profit taking is likely fairly soon. You can still sell the close, but we're probably going to pull back. 13, another big bear bar. If you are selling closes or short, I would get out probably above any bull bar and at least maybe 1 point above any bar. Why 1 point above any bar? Because if the market goes above this bar, even 1 point above, if it goes up quickly, it'll be strong enough for at least a second leg. Therefore, a lot of traders will not be interested in holding. Too much risk, we could get a sharp reversal. It's similar to selling closes down here. If you get a big bull bar, better to just get out and look to re-enter. 14, now we have even more consecutive bear bars becoming climactic. I would get out of I'd get out of shorts, and bulls probably will start buying down here, at least scaling bulls, betting on a pullback, maybe back to the open of the day. Certainly reasonable for bears to start taking profits. 15, you can see we rallied and we're testing back to the 12 low. The 12 bar 12 is a doji, and that's an area where a doji is two-sided trading. So in order for the market to form a doji, that means the market has to go sideways. This dotted line is a 221 input of a moving average exponential. So the input's 221. And the reason for that is it mimics at least within reason, it mimics the 60-minute moving average. It's not exact, but it's at least within 3 or 4 points. So even if it's within, let's say, 2 points, it's at least close enough to remind me on this chart that we're approaching the 60-minute moving average. Remember, a moving average is a band, so we can go a little bit above it, turn down. We can test near it and turn down. It's all relatively the same. But for the 60-minute, it just reminds me that support is nearby. So 15, I would get out of shorts above 15 for sure. What about buying above 15? You can, but it's pretty aggressive. 16, follow through, close. 15 closed on its high. 16 closing above 15. Probably strong enough for at least a second leg up. So I suspect there's buyers below 16 scaling in lower. Therefore, if this is strong enough for a second leg, a lot of bears will be pretty quick to exit. And then you can see what happened. 17 more traders exiting. This is a problem. The opening 4 bars of the day is a problem for the bears. This is also a channel. We sold off, had our deep pullback, and then we're getting a pretty strong climactic second leg. So this is basically a second leg trap. Leg one, pullback, leg two, and a climactic second leg. Or you can say leg one, pullback, climactic second leg. 18, bear bar, but strong enough. 15, 16, and 17, probably a second leg up. So probably buyers below 18. Where will traders start to sell? I don't think there's a lot of sellers here because when I look at this, bar one is an obvious magnet. The open of the day is an obvious magnet. So to me, we could easily vacuum up to this area and start to go sideways. So if I'm a bear looking to sell, I'd rather wait and see the second leg up. I know the odds are 15, 16, and 17 are strong enough for at least a second leg. And the second leg's probably going to go more than one tick above 17. 18, or excuse me, 19, buy vacuum test of the open of the day. But look at the past 6 bars. All the bull bars, 15, 16, 17, and then 19, all closing on their highs. 19 is part of a micro channel, so it's still always in long and probably buyers below. 20 is a bear bar. So we rallied on 14, sold off, rallied on 18, sold off, rallied on 19 or 20, and then we pulled back. You can argue parabolic wedge, several ways to draw it, or a wedge, bear flag. You could say the 14 high, the 17 high, and this high. You could say the 12 high, 17 high, and this high. But regardless, tight bull channel, this is probably the first leg, and any pullback we get will lead to a second. 21 and 22, we have 3 consecutive bear bars. Good bars for the bears. Is it sell to close? I don't think so. The channel up to bar 19 is tight, which means probably buyers below. But 21 and 22 is disappointing enough that there's probably sellers above 22. And 23, we got another bear bar. What about buying the close of this bar right here, bar 23, betting on a 50% pullback and a prior, excuse me one second, let me get a sip of water. There we go. What about buying the close of 23, betting on 50% pullback in a second leg? You can. It's possible 23 is a sell vacuum test of support, but you're buying after 3 pretty big bear bars. This is a low one short on a higher time frame. We rallied and then we sold off. And the rally is probably strong enough, the rally being the 15 low to the 20 high. It's probably strong enough for a second leg up. So there are buyers down here. The question is the sell off down to 23 strong enough for a second leg down? 24, we have a bull bar, probably sellers above 23. 24, enough of a surprise. We'll probably go at least a little bit higher, but we may have to pull back first. And then 25, bulls getting looks like resumption. We're testing the high close, 19. So this is important. Will the bulls be so disappointed up here that they sell and we go lower? Or will there be more buyers up here and the market will continue. And 25, a strong bull bar. So any of the bears who sold the high of 23 or the high of 24, betting on a second leg down after 20 to 23, they got trapped. Therefore, there's probably buyers on any pullback somewhere down here. If I'm a bear and I sold the 23 high right here, what am I thinking? Well, I'm thinking I'm trapped. So what am I going to do if the market tests this area? You know what I'm going to do? I'm probably going to buy back my shorts, which means there's probably buyers down here. 27, bear bar, probably buyers below, but possible second leg trap. But I suspect 24, 25, and 26 are all strong enough for at least a second leg up. 27, surprise bear bar, vacuum test of the 23 high. Probably buyers back at the 23 high. But the problem with 27 and 28 is it's a strong enough downside move that there's probably sellers on the first reversal up. There's bulls who bought the close of 26 here, disappointed 27, 28, and they'll probably look to sell any pullback. 29, high one buy, but probably sellers above. 30, an inside bar. And then 31, we rallied. So the bears, they sold off. The first reversal up, which was the high of bar 29, failed and the market pulled back. And the bears were unable to get a second leg down. So 30 is not a great sell above. 31, testing the high close of 26. There's probably sellers up here, but the rally 24, 25, and 26 is strong enough. We'll probably get a second leg. Also, you have to wonder if the market's going to get some kind of leg one, leg two. So leg one, the 15 low. Leg one from the 15 low down to the up to the 20 high, and then leg two down to 24 up to some up here. So we may have to rally and test up here. The other thing is you have to look to the left and see where the bulls got trapped. So bulls, they got trapped. If they bought it's reasonable to buy this low right here, the 5 low or the 6 low, probably buyers below and higher prices. And then look at 7. 7 changed the character of the day. It's a surprise bar. It's minor, but it's probably going to have a second leg. So if you bought the low of 5 or 6, you're trapped on 7. So what are you going to do if you were still long? Are you going to buy that same price level? Probably not. You'd probably look to sell. It's no different than if you sold the high of 15 and the market rallied up to here. What are you going to do if the market tests back to the 15 low? You're going to exit. There we go. So 32 consecutive bull bars. Is it by the close? It might be, but it's a little bit risky to be buying up here. You're buying back at yesterday's low, and it's a possible wedge top, bar 20, 26, and somewhere up here, but still probably at least a little bit higher. 33, 3 consecutive bull bars. Is it by the close? Again, it's by the close, but you're buying the third leg up in what was relatively a fairly strong bear sell off. So when you look at the dominant feature of the day and ask yourself, what's the most impactful piece of the day? It's probably the sell off from the 5 high to the 14 low. So we have rally, pullback, rally, pullback, rally up to 33. If the bear starts selling up here, we could sell down. We could sell off pretty quick. And then look what happened. The market tested both of the magnets. We had a leg one, leg two, which is the gray dashed line, the 15 low to the 20 high, pull back to 24, and then 2 legs up, which tested it to the tick. And we also tested the 5 low and the 6 low. Always in bulls, I would get out below 34. Aggressive bears can sell, but it's an okay sell. The bears, they sold the close. In theory, somebody sold the close all the way down here, and they'll probably sell more below a bear bar. It was reasonable to sell maybe bar 27, but it's hard to sell it because of the 3 bull bars. So some traders, they might wait for 34. 34, it's 3 legs up. So 1, 2, 3. Not a terrible sell. And if a bear did sell it, let's say they sold the close of 14, they sold the close of below 33. So they sell the close of 14. They scale in below 33 or 34, the big bear bar. This is their break even price. Other traders, look what they did. They sold below 14. They sold more below 20. And the market came very close to their break even price. If they would have sold one lot or one contract here and then doubled their position, sold 2 contracts there, that would have given them more than enough room to exit. 35 consecutive bear bars probably sell the close and at least a small second leg down. So anybody that bought below 33 or 34 or anywhere, they bought the 32 close, the 31 close, they're trapped on the bear breakout 33 and 34. So there's probably sellers above and a second leg down. 36, 3 consecutive bear bars, probably sell the close and going lower, but you're testing the high of 24. So some bears, remember what I said? They sold the high of, I'm going to get rid of these lines now that the move's over. Some bears, they sold the high of 23. They sold the high of 24. They got trapped on 25 and 26. And look what's happening. Look what happened right there on 28. The market tested the area where the bears got trapped. 36 is testing that area as well. 37, we have a really big bear bar, but it's becoming parabolic. We have a big breakout bar, 35, and then a smaller bar, 36. We have another big bear breakout bar on 37. Still sell the close, probably going lower, but bottom of a trading range. And if you're a bear and you sold down here, you're disappointed. So what are you going to do when the market gets back to this area? There's going to be traders taking profits and bulls buying. The bears, they don't want to sell down here, and it's the same reason the bulls don't want to buy up here. The bulls bought here and they got trapped on 7. So if they're buying again in this area, do you think are they going to think, oh, well, the market's going to fail this time? Of course not. So if the market failed here already and it sold off, guess what traders are going to wonder? Will any retest lead to a sell-off? $38, a doji, probably sellers above, scaling in higher, but the risk is big. So some traders, if they are selling closes, they probably get out above a bull bar or 1 or 2 points above any bar. 39, probably sellers above. 40 is an inside bar. So that is becoming a little bit problematic for the bears. The inside bar on 40 increases the probability that the bulls might get a second leg. So maybe leg 1, pull back leg 2, and it's possible we get a strong breakout up to here. And by strong breakout, we get a move up to here that pulls back and gets a second leg. So the point I'm making is the sell-off from 34 to 37 can have a very deep pullback. 41 and 42. 42 is a downside breakout, but it's testing the close of 38. Testing the close of 37 and 38. So there might be more buyers down here than sellers, but I suspect the bulls that bought below 41 are disappointed, so they might sell out of longs on any pullback. 43, we have a bull bar. It's a doji, probably sellers above scaling in. It's a double bottom with 38, but it's a minor reversal. And then you can see what happened. The market retested the 41 low and turned down. So traders who bought the 41 low, they were so disappointed by 42 and 43. Look what they did on the rally at the 44 high. They sold out of longs back at their original entry. 45, an inside bar. Second entry buy, second failed breakout of bar 38, but becoming a tight trading range. It's possible this is a spike and channel. Spike, pullback, and a channel. What are the odds that we get a measure move down? We might, but I don't think it's likely quite yet. But it is possible. 46, bear bar, probably buyers below. 47, another bear bar. It's an inside bar. Let me just make sure it is. Yeah, it's an inside bar, big risk, forcing traders to sell low in the range, not ideal. And then we got 48. 48 is enough of a surprise. It will increase the probability that the market will go a little bit higher. But then look at 49. 49 sold off and then rallied, closing on its high. 49 is a deceiving bar because it's follow through and it looks like a follow through bar, but you have to think about what the market's doing right here. So if you look at it, trying to think of an example. This bar on 48 rallied, and then look at the open of 49 and look at the low of the bar. What did the market do on 49? The market sold off on the open of 49 and found buyers, and then it rallied to a new high. So on a very small time frame, this is a higher high. This is two legs up. We rallied on 48, pulled back to 49, rallied again on that same bar. And it's also retesting the high of 40. So this might be more of a resistance area. So when you look at 49 and you think, how in the world can that happen? It's already forming two legs up. It's actually nested two legs. The first leg was here up to 41. And then we had a pullback for three legs. And then we rallied again up to 49 or 50. But the rally up to 49 has its own two legs. The single highest probability event you'll see in trading is a breakout and a second leg. This qualifies as a breakout, pullback, and a second leg on a smaller time frame. So when you see that tail, even though it's small on 49, there's added risk that 49 might be more of a sell the close bar than a buy the close bar. It's also the first bar closing above the moving average since the strong sell off down to 37. 51 bull bar, probably. Are there buyers above or sellers above? I suspect there's sellers above 51, and you can take the buy above 51, but the problem is bulls got trapped buying the low of 49 and scaling in. So there might be more bulls interested in selling out of longs here than buying above here. So it's possible 50 is strong enough down for a second leg. 51, we rallied and then we sold off. Probably buyers below 52, but then look what 52 did. 52 rallied and sold off. So 52 is technically a low one short, but it's already two legs up for the bulls. It's kind of like the same thing as 48 and 49. 52 rallied and then it sold off. Well, look what 53 did. If you're a bull and you bought the high close of 52, let's just say, on some time frame, there was a bar that closed on its high, which is the same price level as 52. So somebody bought the high close of 52, or they just bought at the market. And if they bought the high of 52 and then they saw the sell off that happened on 52, what are they going to do on 53? They're going to exit. It's the same thing as if you bought a bull bar up here and then the market sold off for a few legs. What are you going to do on a retest? You might just look to exit. 54, 55, three consecutive bear bars, but probably buyers below scaling in lower. It is a double top, so double top with 40, 41, and 47. The bears, they want to measure and move down and a break below the 15 low and a test of the 14 close. 50 is strong enough for a second leg, and it's possible 54 and 55 is that second leg. And then 56, a bull bar, but the bulls are just not getting good. They're not getting strong breakouts. They're getting lots of bull bars closing above their midpoints, but only one bar has closed above the moving average since bar 36. And that's a warning that something is wrong with the bull case. 57 breaking out below the possible wedge bottom, 38, 48, and maybe 55. And then 58 is a follow through bar. 57 and 58 to me should not have happened. Yes, it is a second leg down from the sell off on 50 from the first bear breakout down. It's a second leg from this sell off down to 37. So sell off, pullback, second leg. But 57 and 58 is late in a move, so it's possible exhaustion, but it's enough of a surprise that the market will probably get at least a small second leg. 59, a doji, so it's a pause in the breakout. And then 60 is a big bear bar. 60 is probably exhaustion. It's a second leg down after 57 and 58. And if you look at it, think about what the market's doing. The market's allowing traders who sold the close at 58 and put their stop above 57. They've already made 1 times the risk. So this is potentially all that is needed for the bears. But 4 consecutive bear bars, probably sellers above scaling in. We had a strong rally up to bar 4, strong rally up to bar 33. So there's probably buyers below this red line. There's probably buyers somewhere below 15, but we could easily fall a little bit lower. 61, a bull bar. Are there sellers above or buyers? There might be more buyers above 61 than sellers, but it's probably a minor reversal. It's a second leg down after the sell off down at 37. But if I'm a bear, I would certainly get out of longs. I'd certainly get out of shorts above 61, and aggressive bulls will buy. 62 is a bull bar, but it has a tail. So it's a trend line break from 61 and 62. The market rallied up on 61 and 62 and then sold off on 62. So if you bought the high of 62 and you see that tail, that might tempt you enough at least to look to get out, break even back at your original entry. And that's in part why 63 sold off. 63, low one short, but probably buyers below, scaling in lower. 64 is a second leg up from the 61 low and the 62 high rally. And then 65, pretty much an inside bar, so becoming more breakout mode. Possible second entry buy, but a bull bar, better to wait for a bear bar closing on its low. And then you got 66, a big bear bar. What about selling below 66, betting on a low too short and a second leg down from 60? You probably will get a second leg down, but my only problem with selling below 66 is I think you've got to be pretty quick to make fast decisions. We may just get a sell vacuum test of the 60 low and then a reversal up. And 67, 68 consecutive bear bars, 69 another bear bar, but the body's getting smaller. And then you can see what happened on 70. 70 is a surprise. It's a bear breakout, breaking below a lot of bars to the left, but it's basically a spike, pullback, and channel, and consecutive sell climaxes here, here, and here. So is there any way I'm going to sell the close of 70? There's just no way. I suspect there's probably buyers below scaling in lower, but getting late in the day, so really better to probably just wait. 71 bear bar, and then 72 another bear bar, and then the market rallied up into the close. Notice the high of 61. 61 was a reasonable buy, and if you bought above 61 right here and use a wide stop, and let's say you bought and you put a stop 10 points lower, 15 points lower, or maybe you just put it 2 or 3 times the range of this bar 61, and you're willing to scale in lower, you're probably going to make money. There's a 60% chance you will make money. So if you bought more above a bull bar, not great. But maybe you bought above one of these bars. Look what happened at the end of the day. The market tested the 61 high. Give me just 2 seconds. For stop entries, I thought it was aggressive to buy above 3. Some traders will, hoping on a second leg, but not really ideal. Probably sellers above. And maybe you sell below 7, and not really a great stop entry, but it's a breakout and it's probably enough to make it always in short. You can buy above 15. It's pretty aggressive. If you're buying above 15, you're buying betting that there's going to be profit taking and there's going to be a strong enough rally for at least a second leg, maybe up to the open. If I did buy above 16, if you bought above 16, you get out below 19. And this is basically always in trading. You get out below 19. Do you sell below 21 or 22? You can, but probably better to not. Strong enough rally, probably a second leg up. So the Bulls, if they get out below 19, they probably have to buy again above 24 or probably better 25. And they can get out below 27 if they want. I don't think they have to. And then the Bulls probably have to buy again above a bull bar closing on its high, like 31. But 31 is also a third leg up. So there's a greater risk that whenever you have 3 legs up, 1, 2, 3, and a bull breakout of the channel, which is right here. So this is a bull breakout of a bear channel. And because of that, it's a bull breakout of a bull channel. 1, 2, 3. 75% chance you're going to test the bottom and probably test the bottom of the third leg, which is right here or here. So not really great to buy the close of 32 or 33. And if a bear gets out below 27, maybe they get long again above 31, but again, third leg up, not ideal. They definitely get out of longs below 34. Aggressive bears can sell below 34 or 35. And do they get out above 40? I don't know. I don't think, you don't have to. You're probably going to get a second leg. It's okay to, but if you do get out above 40 right here, what do you do on 41 or 42? I think it's really hard to convince yourself to sell again after below 41 or 42. But if I did get out above this bar, I'd probably just wait through here. So what would you do next? Not really great for buying and selling. You can buy above 51, but surprise bar on 50. So probably a second leg down, so not ideal. And you can sell below 53. And this is a tight trading range. So it's basically a triangle 50-50 chance that you'll get a bull breakout, 50-50 chance you get a bear breakout. In general, 50% chance the first reversal fails and the breakout goes the other way. In other words, 50% chance that the first breakout fails and the market goes the other way. But if you are selling it, it's probably, it's not a terrible sell. You're holding below the moving average. So the odds probably slightly favor the bears. 55 sold off and rallied. Probably sellers above 55, but the bulls are collecting a lot of bull bars here. So I suspect we're probably going to form a bottom and hold above the 15 low. And then 57, a little bit of a surprise, breaking below a lot of bars to the left. Is it always in short? I don't know. Arguably we never went always in long after bar 37. But we have a low close nearby, so probably going to go a little bit lower. If the market gets a bull bar closing on its high on the next bar, I would certainly get out. 58, another big bear bar, but consecutive bear bars probably sell the close and going lower. This trapped bulls. If you're a bull and you bought the 14 close somewhere over here, as the market's going down, you're buying the close, betting that bears will buy with you. You got trapped on 57 and 58, which increases the probability of lower prices. And you can see we sold off down to 60. 59, a doji, so it's follow through. It's a pause after the 57 and 58 breakout. So the market paused on 59 and then 60. Obviously, traders sold pretty aggressively on the way down. And bulls and bears also started buying the close of 60 looking to take profits. Give me just a second. 61. I think it's okay. I would certainly 61, probably best to exit shorts above the bar. And bears, maybe they can sell again below 66. I know I forgot. I think I was talking about stop orders. I kind of went sidetracked. But bears can sell below 57. They get out above 61. They probably sell again. If they're really aggressive and determined, they sell below 66 or 67, but I don't think they have to. It's getting pretty climactic and a lot of trading range price action here, here. So to me, I think it's okay to let this go. But if you were trying to trade always in, you sell below one of these bars and you hold into the close, and you probably get out above one of these bars or below 75 for limit orders. I think probably buyers below 2 and maybe buyers below 5. That's kind of aggressive. 2 legs up near the moving average. Probably sellers above a bar. I say that none of these bars triggered. Probably sellers above any of these bars, but they didn't trigger. So if you sell above a bar like 14 or 15, you're selling a micro channel that's gone on for a lot of bars. Here's bar 4. So 4 all the way to 15. That's 11 bars. An 11 bar micro channel has a greater risk of reversing. So if I did sell above any of these bars and I saw 15 and 16, I'd get out, especially if I saw 17 as well, and I'd reverse to go long. Probably buyers below 20, but the pullback could fall all the way below the 18 low. I said it's 3 legs up, and it's at least 2 legs, possibly 3. Rally on 14, pullback, rallied up to 15 or 16. So rallied on 14, pullback, rally on 17, pullback, rally up to 20, pullback. We could easily test the 19 low. It's also possible it's a two-legged pullback on a smaller time frame. We rallied up to 17, pulled back on 18, rallied up to 19. So second leg trap, you expect a test of the 18 or the 19 low. And probably sellers above 23, but not ideal when you have such a strong rally up to 19. Plus, the open of the day is near. Probably buyers below 27 or 26, but again, not ideal either. We could easily trap the bulls and sell back off to the 24 close or 24 low. But probably buyers below 27 and buyers below on the close of 28 or below 26. Probably sellers above 27 on the rally up to 32 and 33. And the reason is this is resistance where bulls got trapped. And you can see that's the red line. Probably sellers above 38, but forcing you to sell low in the bottom of the range, not ideal. Probably buyers below 43, but the buyers may not come in until we go below 38. And we went sideways. So you could buy below bars, sell above bars. And then the bulls that bought below 53, 54, they had a brief chance to get out near break even on 55 and 56, but if they chose not to, they got trapped on 57 and 58. Probably buyers below 63 or 64, but they didn't trigger. And really, whenever I get a situation like this, it makes sense to buy below what bar is this? 62. It makes sense to buy below 62. But if you do buy below 62, you're buying because the rally from the 60 low to the 62 high is strong enough for a second leg. And if you go sideways like this, the second leg's over. You're buying. In essence, what you're doing is trying to think of a good example. It's like bar 1 and 2. Bar 1 and 2 are so strong that the first reversal below 2 is probably going to fail. So if you buy below 2, and you put your target, let's say near the two high, you've got a really, really high probability of making a profit. But the problem is if you buy below two and you don't get out up here, the move's over when you see five, six, and seven. So this is basically a low one short on a higher time frame, and it broke to the downside. For buy the close, sell the close, I thought it was buy the close on two, but it's a little bit of a little aggressive. Probably sell the close 7, 8, 9, 10, 11. What about sell the close 12? You can, but 12 is that warning. Whenever you get a doji after five or six sell the close bars, you're typically going to get one or two bars of sell the close left before you get a reversal. So when I see a bar like 12, it's like a big red flashing light going on in my head telling me that we're going to pull back to the 12 close. And probably buy the close 16 and 17 for a second leg. Probably buy the close 25, maybe 26, but 26 is forcing you to buy fairly high in the range. It's forcing you to also buy near the 7 close. So there might be more sellers up here. And 35, 36 sell the close, 37 sell the close for a little bit lower, but a lot of traders would probably just get out in here. 48, is it buy the close? I don't think so. I think the bulls needed to do more. 48 strong enough for a second leg, but if you're buying that, that's really aggressive and it's at the moving average. So a lot of traders, if they're buying 48, they know it's low probability. If the market doesn't just quickly go up with almost no pullback, they might exit. And that's what happened on 49. Instead of going straight up, the market went down a little bit and then hesitated and then went up. I'm sure if we look at this bar, this is, let's just look. So this would be, I just want to see one thing. So this bar is 1230 to 1235. I want to look at a 1 minute chart and see how the bar formed. A lot of times, if I want to see how the bar formed, I'll go to a smaller time frame. In 1 minute chart, at least lets me see the bars. So this was 1230 to 1235. There's 1230. So there, this bar right here is the buy the close bar of 1230. So a bull, they buy the close at 79.5, which corresponds to right here, 79.5. Let me get back to that bar real quick. Okay. So a bull buys the close of 48. Then they see 49. Disappointment. The market immediately went down as soon as they entered. And then the next bar, the next minute of the bar still went down. And then we rallied into the close, but rallied with the tail, rallied with the tail. So there's a lot of overlap in this bar. If you bought this close, the market went below your entry price. It went above your entry price, went below it here, went up, tested near it, and then went up. That's a lot of overlap. And because of that, it will increase the probability. It increases the risk that traders will sell. Disappointed bulls sell out of longs. Maybe sell the close on 50, but aggressive and near the lows. So probably better to sell a pullback, sell the close, maybe 57, better 58, even sell the close 59 for a second leg. What about sell the close 60? I would not. 60 is a gift, allowing traders who sold the close anywhere to make a quick profit. And 59 is also kind of like bar 12. It's a warning that the market may not go much lower. And probably maybe sell the close 68, 69, but so late in the day, I would just let it go. And we pretty much went sideways after that. Let me take a look at a few questions. Are there any trapped bulls on the daily for bears to flip the market to bearish? Trapped bulls, there's always trapped traders. Every breakout will trap traders. But what you're asking about is right here. Here's the daily chart. If you're a bull and you bought the high close or the high close up here, what are you thinking on the current day, the big bear bar? You're disappointed. So the question is how fast are you willing to get out? Some traders, they'll buy more lower and they'll just get out break even. They're so disappointed, they'd rather get out and look to re-enter later. Other traders, they'll say, "Yeah, whatever, I'll buy and scale in. I know the market will let me out." But if we start to get another, if tomorrow looks like June the 16th, this big bear bar, and it's closing down here, and we start closing below the past 4 or 5 or 6 trading days, that will increase the probability that the market can go higher. I do think we're going to get back to this triangle right here at some point. I don't know when exactly. 1 second. Question: was 20 a reasonable sell? We had magnets below the 14 close, but I thought the bull channel was too tight. I see bars like 24 in this context a lot, but can you explain the logic behind bar 24? Okay, so first let's talk about bar 20. Was bar 20 a reasonable sell? I talked a little bit about this. So bar 20 is an interesting bar. And you look at bar 20 and you say, yeah, it's a wedge or it's 2 legs up and we have a strong sell off down to the 14 low. It's got to be, it's a sell to close bar, sell a pullback. We're going to go back to the 14 low. And the reality is the problem with this bar right here is the rally up to 20 is strong enough that it may get a second leg up before the bears get their second leg down. So let me try to see if I can pull up something real quick. Let's see if this works. Almost got what I'm looking for. So basically what you're asking is, let me do this. So here is a screenshot of the day. And there's 2 things we have at play here. One is the obvious, this big sell off. So we have a big sell off down to here. And actually, let me do this. I did not mean to do that. So, anyways, we have a big sell off. And you expect 2 things to happen. Either one, we're going to sell off and we're just going to keep going down. Or 2, we're going to sell off, pull back, but the first reversal up will fail, and then we'll test the lows. So at a minimum, you can sell the low close, scale in, and get out. And that's what you're saying right here. You think that by selling below 20, your expectation is bear flag and lower prices. But what happens, what's pretty common is that the market will never really used this before. What's common is for the market to do this. You get a sell off like so, and Then, this is in a trading range. You get this surprise rally, and the rally is fairly strong, and it's strong enough that it goes greater than 50%, but it's a strong enough rally that if you buy the rally right here, in other words, if you buy 17, you have time to scale in and probably get a second leg. So if you're a bear and you're selling in this area right here, you've got to probably hold through two legs. That's why a lot of traders get out on 15. They see 15 and they think, yeah, 15 is strong enough for a second leg up. So why sell it? If you think there's going to be a second leg up, why would you sell here? Because you know the best you're going to get is sideways. So when they see 20, they think the downside's limited. So even if the market pulls back down to here, they expect buyers for at least at a minimum a test up here. And a lot of bears, they know that. So a lot of bears, if they're selling on the way down and then they detect that this rally here is too strong, which is basically bar 18 right here, if they think that's too strong, they'll exit because they know the first reversal down will fail. So let's go back to your question for just a minute. They thought, was 20 a reasonable sell? I don't think so. I think it's reasonable to get out of longs, but I think there's buyers below. We had a magnet, the 14 closed. You're correct, but I thought the bull channel was too tight. It seems like bar 24 in this context happens a lot. Can you explain the logic behind it? Yeah. So there is, you've heard Al talk about the 80% rule. There's the 80% rule and the 60% rule. And typically, what it means is there's an 80% chance if you sell down here, and you sell more below a bear bar, that's a reasonable bear bar. You could argue this is reasonable, but it's a micro channel. So a lot of traders arguably may not sell here. Some would, others would wait for a second entry, either 27 or 33. So really, you have three choices. You could sell here, you could sell below this bar, or this bar. I think a lot of traders would not necessarily sell here. They'd probably sell below 27 or better 32 because the rally up's too strong. However, if they did sell below a bear bar like 20, they're probably their main interest is getting out break even. They're selling, they're scaling in, and the only thing they're scaling in for is to avoid a loss. So you'll see that all the time, and that happens a lot with 50% pullbacks. So if you sell here and you sell more below this bar, this is basically break even, although break even I think was down here a little bit. So it didn't quite reach break even. But if you sold one contract and then you sold two contracts, doubling your position, you would have gotten out break even without a loss. Okay, question. Was the open of bar 75 a reasonable buy the close bar? Was the open of bar 75 a reasonable buy? There's two things going on with 75. One is 75 is there's bears who were short down here. Let's say some bears sold above 72, which was not ideal too late in the day after consecutive sell climaxes. Some bears, they sell above 72 and then they see 73 and 74 and 75. And that is strong enough that it trapped bears who sold above 72. They got trapped on the upside breakout, 73 and 74. So if you're a bear and you sold this high and you scaled in, what are you going to do on any pullback? You're going to buy. You can buy 75, but time of day is a little bit of an issue. There's a couple of things I thought going for it. One, I thought there's buyers below 75, even if we reach the 72 high all the way down here. If you buy here and you scale in, you're probably going to make money, but it's getting late in the day, so it's not that easy. The other target that I thought that made the bulls have a reasonable chance here was bar 61. It was reasonable to buy 61 and scale in lower. And whenever you do something reasonable, 60% of the time, the market will allow you out of the trade, which is what happened at the end of the day. Question: what type of day was it today? Was it a broad bear channel or a trending trading range? It was both. Broad bear channels, this is more of it's a broad bear channel for the most part, and it's mostly a trading range day. I get it. You see these big sell-offs here and these big sell-offs 57 and 58. But if you really go back to the day, you had a lot of overlap with the day. So we have these overlapping bars here. You see this bar 7, you're thinking, yeah, it's trading range. And then we see this and you say, oh, we're breaking the downside. Okay, it's a trend. And then it lasts for a few bars. But then look, then you get these overlapping bars. So probably in a trading range now. And then we went sideways for just so many bars. We have a strong bear breakout. So it looks like it's clearly always in short. But then it goes sideways for 15 bars. Strong bear breakout here. Looks like it's always in short. But then you go sideways for 10 or 15 bars. And then you go a little bit lower. Trading ranges are always doing this. You get strong moves and then sideways. And I thought the end of the day was fairly low, was lower probability. I don't think we made a measured move. Actually, we did. I take that back. So we actually ended up getting a bear breakout below a flag, a bull flag, you can argue. So this rally I thought was strong enough. I thought there was probably going to be buyers somewhere below these lows, maybe below 15. But look what happened. 57, 58. It created a measuring gap right here. And we got a measured move from I'm going to make this I'm going to try and snap this so it's as accurate as possible. Maybe right here. That was one measured move potential. The other. So if you take a measured move from the high of 34 to the low of 54, it takes you down to 57.25. The low of this bar was 57.25. So the low of the day was a measured move target from the high of this bar to the low right here. But back to your question, and this person has the pretty much the exact same question. Trading ranges and channels, especially broad channels, are almost always sideways. And you get brief periods of always in, where it's clearly always in short, always in long. And in a broad channel, there's typically a directional bias to a degree. It's a little bit more bearish than bullish. You're holding below the moving average. But for the most part, you look at it and you say, yeah, this is, it's fairly one-sided. But the only problem is you get this. You get these strong rallies here that make it probably always in short. Then you get this strong sell-off and you go sideways. So it's easy to forget about this breakout. But for the most part, you could call it a broad channel or a trading range here, and then a downside breakout and sideways. So for me, I think we're probably going to, if you want to talk about what is the Globex session going to do, we're probably going to go sideways here and eventually test back in this range. Another question about, is this a trading range or a broad channel? Trading ranges, a perfect trading range that's completely flat. Trading ranges are forgiving, which means if a trader, one second, which means if a trader buys a breakout and scales in lower, they'll probably make money. So this is a good example. They bought below 1, they bought more lower, they were able to avoid a loss. That's typical in a trading range. Bears sell down here, scale in, they avoid a loss, or it came back over here. Here, bulls buy this low, they scale in. Bulls buy this low of 41, scaling lower, they get out break even. Bears sell the high, or bulls buy the low of 49 and scale in, and they get out break even. That's trading range price action. Trending price action, especially a small pullback trend. Let's just go to an example real quick. Here's a good example. Let's find one a little bit more extreme like this. Small pullback trends. This is June the 27th. They trap traders. So if you sell above this high right here during this rally, you just got squeezed out of the trade. And if you scaled in higher, it didn't fix the trade. You took a pretty big loss by the end of the day. And even if you sold here and held for 2 days, it would still be pretty tough to get out at break even. So trends trap limit order traders, and that's what fuels the move. Trading range price action does the opposite. Bulls betting on breakouts get trapped. Limit order traders end up making money. Okay, let me look for one more question. Okay. If you sold below 34, would you buy back above 40 or bet on a second leg? If you sold below 34 here, would you buy back above 40 or bet on a second leg? This is a common situation for the market. You get a strong sell off, but it's a retest of the 14 close. And because of that, if you're short, you know there's probably going to be a second leg, but you're always wondering, is this some sort of double bottom and is it going to trap traders? This is strong enough on 39 and 40 to probably make the market go sideways for at least a couple of bars, but it's not enough to reverse the sell off from the 34 high to the 40 low. Therefore, even if we go sideways for 5 or 6 bars, it's probably minor. It's kind of like It's sort of like bars 1 and 2. There's probably buyers below, but if we start to go sideways for too long, the bears have a credible shot. Okay. I'll answer this last question and that's it. Question, what are your thoughts on the Nasdaq daily chart bar? Just go to the Nasdaq futures. The Nasdaq daily chart. The Nasdaq, this bar is obviously we gap down and we're going further down. So if you compare the two, we're already testing the breakout point. We're getting really close to it. If I go back to the ES, we have a long ways to go. And that's pretty common. Nasdaq technology stocks, they tend to move more than the overall S&P. And I'm sure there's several reasons. To me, the reason that makes the most sense is they're, a lot of your S&P 500 companies are probably older companies, more developed, and if technology, there's more things developing, and there's plenty of other reasons, but I don't want to go too in detail with that. But in general, the Nasdaq can move, has a lot of more volatility as far as the basket of stocks, and the S&P 500 as a whole has less volatility. That's why you'll often hear people say that the Nasdaq has better moves if you're looking at a 5-minute chart. And the moves are, I mean, it's kind of like crude oil. The moves, they're just more volatile at times. But if I'm looking at the Nasdaq, it's a tight bull channel, and this is a surprise. So I'm expecting a second leg. I'm not expecting a measured move, but I'm expecting some sort of hesitation. So maybe, I don't know, maybe something like this, a little bit of a surprise, second leg. This is closing below a decent amount of bars. So for me, I'm always imagining what would it take for me to buy or sell the next bar. So if I'm a bull, What would it take for me to buy the close of the next bar or buy above the next bar? And here we have a bear bar. But do I want to buy above this bar? Not really. It's possibly two legs down, but it's a tight bear channel, so there's probably sellers above. So the risk, I'm not finding a great example. The bulls, this is a little bit of extreme, but it's not quite, but I don't know, it's good enough. The bulls, the bears are hoping for this big bear bar and then another big follow through bar. And the bulls, or even something like this, surprise bar, even if we get a big bull bar, we may get a second leg, and the bears are hopeful they get that. More likely, it'll be something like this big bear bar and then a bull bar and sideways. But it's a tight bull channel. We're getting close to the moving average. We're testing this breakout point. I think we're probably going to go sideways. But this is strong enough that if I'm a bull and I bought up here, you know, those bulls might be getting out break even, but we'll see. Sight bull channel and the bears, they have yet to get below the moving average. So the bulls are still in control. All right. Thanks everyone for watching. I hope everyone enjoyed this. And a reminder tomorrow, if you're subscribed to the trading room, the end of day review will be there. And the YouTube reviews will be back on Monday. All right. Hope everyone has a good rest of their day.